Going on everyone, today's video topic is going to be covering 5 investing principles that you can use to invest like Warren Buffett. If you'd like to know more about how Warren views business, investing and the stock market, I'd highly recommend reading some of his letters to the shareholders that he writes for his company, Berkshire Hathaway's. If anyone's interested, I'll leave a link to some of them in the description below. The first investing principle that I'd like to cover is investing for the long term. And what I mean by that is when you're buying shares of a company, you want to have the perspective that you're going to have to hold those shares for a period of 5 to 10 years. This will prevent you from getting caught up in the short-term hype and the inevitable, ups and downs that occur within the stock market. Purchase of shares should not be dictated by short-term changes that occur within the market. For example, if the price of a stock has gone up by 20% over the past 3 days, one cannot just buy into that company purely based on this factor and assume that this increase in share price will continue. You want to have the idea that instead of just buying a few shares within a company, you instead become the sole owner of that business. This makes you put much more time and consideration into what shares you buy and makes you have a greater understanding of the business as a whole. Second investing principle is called margin of safety. And what I mean by that is when you buy a stock, the price you pay can directly affect how profitable the investment is. For example, the price of a stock can be undervalued, be it its intrinsic value or its fair value, or can also be overpriced. Margin of safety is essentially a safety net for the shareholder. What you're aiming to do is purchase a company for say 30 to 50% less than its intrinsic value. You want to get say $1 value by paying 50 cents. Purchasing companies at a margin of safety increases the likelihood of the investment being profitable and preventing financial loss. If you want to learn how to calculate the intrinsic value, I'll leave a link in the description below. Process of finding a company's intrinsic value by using the calculation. What you can do is come over to this website called Simply Wall Street. When you sign up, you just need your email address, make an account, and you get a 2-week free trial. Once that runs out, you can just make a new account again to get the trial if you'd rather not pay for the subscription fee. So what it will do, you can see at the top here, it'll tell you at what percentage the company is trading either above or below its intrinsic value. So here we have Facebook trading at 2.6% below its fair value. And if you scroll down, it'll tell you sort of a more detailed image. It'll tell you the fair value, the current price, and if it's either above or below the fair value that's being calculated for it. So with this website, it's very similar what intrinsic value they find versus the one you find by doing the calculation. So it can save you quite a bit of time. A good way to think of intrinsic value is, say, looking at the sticker price when you're buying a car. If the sticker price is $5,000, what you're aiming to do is obviously purchase the car for less than that so you can save money. So you want to get the car for say $4,000 as opposed to $5,000. And you want to have the same perspective with the stock. You don't ever want to pay more than its intrinsic value, and you ideally always want to pay 30 to 50% less than its intrinsic value. So you wouldn't want to buy that car that's valued at $5,000 and pay $6,000 for it, because then you've automatically lost money by doing that. And it's the same perspective with buying shares on the stock market. What you may notice once you start looking at fair values for companies on Simply Wall Street or doing the calculation yourself is that the majority of the time companies are either overvalued or just at their fair price. It's not common to have a company that's a good business with a strong financial prospect to be under its fair value. And this feeds back into that long-term mentality you have to have, that shares are not always available for purchase, and finding ones at the right opportunity at a discounted rate is something that's rare. Moving on to the third point is understanding the business. How does the company you're investing in make its money? What's its long-term goal? What sector is it involved in? Is the sector growing, developing, or has it been declining over time? Understanding the business dictates how well you can invest in that company and the amount of confidence that you can have in your investment. To be a good investor, it is not necessary to understand all businesses. You only have to know a few and make a few good investments to make a profit. When it comes to companies, say for example Coca-Cola or McDonald's, it will be easy to understand their business model and how the finances of the company works. But when it comes to say more complicated things like Enron, I'd have a hard time explaining that, therefore it's not something I would look into buying. On a company is by reading its Form 10K, which is a large financial report that is released annually for public companies. In here, you can scroll down to the table of contents and find out more information on the business model, any risk factors associated for the business, the legal proceedings that it's had, and a large summary of the financial information for the company. Now, if you want to find one of these reports, say we'll just do one for Facebook, you type in Investor Relations Facebook into Google, click on that first link, and then you want to go over to Financials, and then click on SEC Filings, and it'll take you down here, and then on the drop down box you can go through all the previous years of 10K reports, and you can download them as PDFs or Word documents and save them and read them as you learn more about the company. It can be useful to look at a few years worth of 10K reports to see how the company's changed. Has it been improving or declining over time? How has their business model altered over time? Has this been successful? How has the management team gone? Who's this current CEO? All those kind of things kind of play a factor into understanding how the business works. Fourth principle is called a company's moat. So in the same way a castle may have a moat around it to defend it from attack, a company can have the same thing. As an example, there's a brand moat. So when you think of soft drink, you might think of Coca-Cola. When you think of fast food, McDonald's. Or when you think of running shoes or sports apparel, maybe Nike or Adidas. So this recognizable brand moat allows the company to sort of maintain its price without losing customers. So for example, with Coca-Cola, it wouldn't matter how cheap a competitor's version of Coca-Cola or their soft drink is, people will still buy Coke, and Coke can continue to raise its prices without losing customers because it has that long-term, recognizable brand moat. So an ideal company would have more than one moat. With Apple, it has the clear brand moat with the iPhone and all the products that it has. And also it has a switching moat, so a lot of the products that are created by Apple sort of interact with each other, and some features are lost if it's not two Apple products interacting with one another. So if you want to airdrop your photos from your iPhone to your Mac, both have to be obviously Apple products. You can't have a Samsung and have the same features, or connecting your iPhone to your Apple TV. So the idea with a moat is essentially that it improves the longevity of a company, that there's a consistent return and a long-term profit that can be made from purchasing shares. When you're buying companies, you don't just want to speculate on your purchases or form sort of biased opinions on things. Like for example, people might think that during lockdown people watched more Netflix, therefore Netflix is a good investment because more people are watching it, and then they buy shares in the company. You have to have sort of set criteria that are met when you're buying a stock. So these are margin of safety, as we previously discussed, a strong management team, a recognizable moat, and good understanding of the business. That wraps up the video. If you found the content useful and you want to support the channel, feel free to leave a like or subscribe for more future content. Thanks.